Good evening. It's truly a great pleasure to speak to you this evening, to see friends and clients and new faces. Thank you, Phil and Metrobank, for inviting me. I'm going to touch on wealth management and in particular the economics of where we are and what it means to real people, what we can look forward to and what we can do to improve our financial positions. In this presentation of our understanding of where we are and of our expectations, I'm going to state my opinions. I'm going to make forecasts and predictions based on the facts that we see. By all means, question any of my forecasts or opinions, but please don't question the facts. When George Soros invests, he spends far more time thinking about the potential downsides than the potential upsides. That's certainly how we manage client wealth. In investing, there are stages that prices go through, and there are stages through which investor emotions are twisted and turned. As you see, smart money has patience to wait for the great moves. And if something is going to go, it tends to go in a final burst of mania. Then bubble assets will crash and burn, severely harming the illusory wealth of latecomers to the party. In shares investing, people tend to buy high and sell low. At Jonathan Davis Wealth Management, we help our clients to buy low and wait, and then sell high. In every single case of asset bubbles in recorded economic history, over 400 years, the bubbles have always burst. Bubbles are popping everywhere, and they've been popping regularly since .com in 2000. Markets go up in an escalator and down in a lift. Please bear that in mind. UK housing is a perfect example of this chart. Through the 1990s and early 2000s, while interest rates fell, and lending rose and rose, prices grew and grew until there was a manic rise from 2005 to 2007. Then we saw, with the 2008 financial collapse, the first big move down from the end of 2007 to the early part of 2009. With the slashing of interest rates in 2009 and the bailing out of, I hasten to say, the other banks, the other insolvent banks, the housing market came back up strongly in 2009 into 2010 and has been collapsing since then. The number of sales is down 40 to 50% compared to the highs of 2006 and 2007. Prices are likely to follow the market. Isn't it fascinating that with the lowest borrowing rates in history, prices aren't rising, and certainly neither is the market? Let's have a look at an investment. As you see, from 2006 to 2010, it seemed fairly quiet. Do you think the smart money was getting ready for the manic phase? Maybe they were, given what happened next. The problem is, this is not a chart of huge rises. It's a chart of huge falls. What you're looking at is the movement in Greek interest rates that the Greek government has had to pay to borrow over the past few years. In other words, had you been a lender to Greece, you would have seen the value of your loan or investment crash and burn since just 2 years ago, as Greece moved towards bankruptcy as it is in now. To cut a long story short, the interest rates that governments borrow at move inversely to the value of the loans. So as the rates soar, as here, the values of the loans collapse. Next will be Portugal, then Spain, Ireland perhaps again, maybe even Italy. The global financial system doesn't have enough money to bear the losses. Let's look at another market. If we accept that markets ebb and flow, they rise and then crash and then rise again, what's most likely to happen with this market? Expected to rise. Anyone know what the market is? Whoever said UK interest rates got it right. Knowing what you know, can UK interest rates fall? I see shaking heads. Therefore, there are only two things that can happen to UK interest rates. Either they remain as they are, or they rise. Are you aware that by May this year, nearly 2 million mortgage holders will be paying between 5 and 15% more per month to service their mortgages, even though the UK rate is unaltered? That's a long-term picture, and at some point in the future, we will head back to it. Money printing, or as they embellish it, quantitative easing, is like cutting interest rates. However, it stores up even bigger problems and creates even higher interest rates in the future. Another market. See, it's risen strongly in the last 3 years, 2009, 2012. Does that of itself mean it will continue rising? We've seen how markets ebb and flow. What goes up will highly likely come down. Do you know what it is? That man again. Up 70% over 3 years. But look, most of the rise came in the first year. Taking out this recent rally at the end there of a couple of months, the stock market has done nothing since the spring of 2010. More and more people are now investing in the stock market after it's risen. If you look at the longer term, we see the stock market is still in a downward trajectory, punctured by rises. In other words, stocks moved from a long-term bull market, i.e. rising, from circa 1980 to circa 2000, then after .com, to a long-term bear market, i.e. falling. In 2008, following a few years of huge rises, companies went bankrupt. In 2012, as the stock market peaks, countries are going bankrupt. In our view, stock markets are peaking around here, and we are in yet another manic phase. This will result in another period of crash and burn. Your pensions and stocks and shares ISAs and other investments will fall considerably. We have moved our client portfolios over the last year or so from leaning bullish to leaning bearish. Thus, our clients will not lose half their wealth in the crash. We will actually make them some money. After the crash, we will move back from bearish to bullish. Our clients will buy in their pensions, their ISAs, their offshore arrangements, etc., at ridiculously low prices, with their wealth already enhanced, not crashed and burned. Let's look at the government finances. Government revenue, £575,000 million, 575 billion. Spending this year, 702 billion. The amount they'll borrow this year was £127 billion. Thus, £1 in every 5 that the government spends is borrowed. £127 billion is the deficit. The debt that's on the government's balance sheet is £1,000 billion, £1 trillion. That doesn't count the debt that's not on the balance sheet, such as state pensions, civil service, public sector pensions, the private finance initiative, the schools and the roads that were built over the last 10, 15 years. It's estimated that the total debt that the UK government has is about £4 trillion, 3 times the size of the economy and 7 times the size of its income. Let's consider those numbers in the context of a family by taking away 7 zeros. Family income, 57,500. Family spending, 70,000. New debt on the plastic, 12,500. Going on to the existing plastic or HP or car loan of £100,000, not including the mortgage. This, shall we say, average family has got £300,000 or £400,000 of debt with £57,000 of income. Never before has a government anywhere in the world or a family anywhere in the UK got out from under without going bankrupt with those dire numbers. Throughout the 90s and most of the 2000s, the economy just grew. Not strongly, but growth nonetheless, as did house prices and largely the stock market. Then reality hit home towards the end of 2007. We had the biggest economic and financial collapse in human history. It's still ongoing. It hasn't been sorted. Our view is that we recently again re-entered recession, and we will experience very low growth, i.e. not enough, or recession for many years. Here's an interesting statistic. Those 400 years of recorded economic history. It took 400 years until 1997, when there was a change of government, for household debt to rise to £500 billion, £500 billion. 400 years. It doubled over the next 7 years. Household debt is beyond massive. That's the reason why we got the growth in the 1990s and most of the 2000s. The fact is, from 2006 to 2011, 5 years, we've had no growth in this country. Portugal and Italy have had no growth for 10 years. Greece, in the last few years, has lost a quarter of its economy. So reality hit home in 2008. The financial system collapsed. Companies and people went bust. The economy went into tailspin. Then, instead of letting the economy find its true level, they borrowed a vast amount more and pumped it into the system. They didn't save the world. They compounded the problems. They pushed back the inevitable further adjustments to a later date. Well, 4 years later, we are at a later date. Unemployment is rising. The costs of living and running businesses are rising. Retirement ages are rising. Earnings are at best flat. The economy is flat or in recession. House prices are at best flat or falling. Taxes are rising. Public services are falling, and so on. The UK, on the left of the bar chart there, now has the highest level of total debt than any comparable country or economy on the planet. You're doomed. Doomed, I tell you. Doomed. There is nothing you can do. There's no action you can take. And Old Faithful, my house is my pension. And rent from my investment properties will never go down, even though incomes aren't rising and unemployment is. If you're ill, you go to a doctor. If you're potentially financially ill, go and see a financial doctor. It is certainly not too late to take preventative measures. The stock market is on a very significant high. Lock in your gains. And I'm afraid to say, those who believe that their house is their pension, to put it mildly, you're going to be severely disappointed. So if you need help, it's available. Go to the right kind of help. Not a salesperson or an amateur pretending to be a professional, or a wolf in sheep's clothing. Qualified, expert, truly consultative, with clear fees agreed before they undertake work. I'm very, very happy to take comments, questions, disagreements. I would appreciate it if you keep abuse to a minimum. It's more than they say. I find it amazing that they don't take into account housing costs in inflation. And there are some aspects of energy that they don't take into account, which I find remarkable. Somewhere between 5 and 10%, but it's going to be different for most people, but I would say between 5 and 10%. That's the real inflation that people are experiencing. Our clients, as I say, are very bearishly positioned. We're expecting, as I say, a significant stock market crash, and that will impact also on commodities such as gold, silver, even food, copper. Oil is staying up there right now because, in our view, what's happening in Iran. But as the global economy is in recession, China is practically in recession, America's moving into recession, the EU and the UK is obviously in recession, most of the world's in recession, so the amount of oil we're actually using is going down, but the price has been kept up because of Iran. So we're very, very bearishly positioned right now. As I say, after the next crash, which we believe will be as big as 2008, then we'll go straight back in, and it'll be like kids in a candy shop. When Greece went bankrupt very recently and defaulted on its debt, it said, we're not going to pay it. Then the European Central Bank came in and lent them a whole lot more money. At the same time, there was a huge liquidity crisis in European banking, so the European Central Bank over the last few months has effectively handed €1 trillion to European banks at 1% rate to be paid back over 3 years. Well, first of all, they're not going to pay it back because they will not have the resources to pay it back. That's by the by. By printing that money, by creating that money and handing it out, they devalued the euro. Now, currency, global currency is a zero-sum game. The euro is the second biggest currency on earth. When the euro goes down, the dollar goes up. And when the dollar goes up, it's very bad for basically everything. It's bad for commodities. It's bad for shares. It's bad for the economy because it costs people more money to do what they need to do. And the dollar indeed has been rising since last summer. Our view is that for the rest of this year, the dollar is going to continue to rise, indeed possibly soar. And as that process continues, it's going to bring everything down. No one's going to ring a bell. Not in the way that it is just now. I see some countries leaving it, but there may be a surprise there. It may be Germany that leaves it, because it may be the Germans who say, we're not going to pay for these guys any longer. I don't know, but I don't see it continuing in the format that it is. No, it wouldn't be Germany and France. There would be a few more countries. Netherlands would be there, for example. Maybe Italy, I don't know, although Italy is a basket case. I would not be holding my savings in euros. We did and we've now taken out of euros, put it into dollars. I thank you very much for your time. The gallows are being built outside for anyone who wants to make use of it. The thing is, there is something you can do, and that's what matters. Thank you very much.